Be Wealthy and Smart, episode 735.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the stock market speculation has gone wild. I mean, it's really gone wild. Wow. So I'm going to share with you some things that are going on that are telling me that there's a lot of speculation right now, which usually is a contrarian indicator, as we've talked about. But I don't think it's a contrarian indicator to the degree that this bull market will stop. I just think we're ready for a pause pretty soon. And from there, we'll still resume. However, there is some craziness going on. And I don't remember seeing this since maybe 2008. After that crash, I did see some in the rebound after 2008. Someone I know in 2008 was buying penny stocks, and they were bouncing like crazy from the bottom, and they were sometimes doubling in price. And so this particular person started trading these penny stocks. And he literally thought this could be done forever. He thought this is the way the stock market operated because he wasn't a normal stock market investor. But he just found this one method somehow that worked. Well, it worked for a while, and then it didn't work. And unfortunately, then he started losing his money, and he forgot he had to pay tax on all of his gains because everything was in a taxable account. So then he had the IRS chasing after him. So it wasn't a pretty story. While he was having success and I didn't want to rain on his parade, I knew it wasn't something that would be normal in a regular stock market environment. And just like that, we have speculation right now that's happening that isn't normal or sustainable either. So what am I talking about? Well, I think I mentioned recently that CNBC reported, according to Citadel Securities, that sub $1 stocks in the Russell 2000 are up 79% on average in just 5 trading days. That is crazy, where companies that are priced below $1 have gone up 79% on average in 5 days. And here's the thing. There's a lot of new investors who are the ones that are investing this way. And not only are they new investors, because the statistics are crazy. I mean, the numbers are phenomenal in terms of the number of new people that have signed up to trade. And many of them through a particular app that starts with an R. So we've seen that there are brand new people trading for the first time, and this is their first experience of investing, and they probably think that this is the way the stock market normally works. But it doesn't. This is unusual because we were in a deeply oversold situation where the market sold off, went down basically 40% very quickly, the fastest in history, and is bouncing back from that. And it's only because it's bouncing back like a rubber ball that it is getting this incredible bounce. In stock market lingo, that's called a dead cat bounce. But here's what we have found out since. According to Zero Hedge, which is one of my favorite publications for financial information, some of the people that are trading are 10 years old. I don't even know how that's legal for them to trade at 10 years old. I didn't think you could. But these 10-year-olds say they can only play Fortnite in the evening because half of their squad is trading, and they're 10 years old. Now, if that isn't enough, there was another story in Zero Hedge. Someone was reporting a really tragic story, a very sad story, about their cousin who opened an account with that app that starts with R, And he believed when he opened the account, he checked no margin. That means he didn't want to borrow money to trade his account. And he began to buy and sell options, betting directionally on the market going up or the market going down. That allows you to really leverage and for a small amount of money, really magnify what your returns can be. Well, unfortunately, it got to the point that his account said he owed $700,000. And the saddest thing is that apparently he took his life over this. Now, the article says that the person reporting to Zero Hedge about their cousin never actually saw the account. This is all according to a note that was left by the person who committed suicide. So it's so sad and just so terrible that this happened. This kind of speculation can lead to huge losses, whether you're trading on margin or not. If you're doing speculative things like buying stocks below $1 or buying companies that are bankrupt, like people that bought Hertz after it declared bankruptcy, and yet the stock happened to bounce on that and people just piled in and were moving the price through momentum of the crowd, that is not a healthy way to invest, nor is that a normal way to invest. That is pure speculation, which is a sign that we are ready for the market to pull back and correct the excesses, the speculative excess out of the market. And that's what I think it's telling us is we're overdue for that. Now, the reason why I don't think we're quite due for the big correction or the end of this major move back up, and why this is just going to be a pullback along the way, is because the majority of people are still bearish. 38.1% on average are still bearish, 27.7% are neutral, and 34.3% are bullish. So we have the most people bearish, then bullish, and more than a quarter of people are neutral. So this tells me that we're not overly bullish. And that's usually when the end of a major run comes, is when we're overly bullish and sentiment really swings in that direction. Now, again, this is one of the fun indicators that I follow, not one of the real technical indicators that I follow, but you can use this as a very good guide, actually. It works quite well. You don't have to follow all the numbers and all the charts and all the graphs and all the other things that I follow. These little anecdotal things work really well, and sentiment is one of the best. The other thing that works really well as an indicator is what I call anecdotal evidence. This is one of my favorite things to gather because back in the day when we had the housing crash and real estate prices peaked in 2007, I was able to figure out that we were close to a crash just by making observations, and it helped me sell my home at a time when I was ready to sell and I wasn't sure exactly when to sell. It told me that was the time to sell. And so I was able to maximize my gains and move on to where I wanted to go. So anecdotal evidence is what you observe around you. It's kind of like what Peter Lynch said when he said, go to the mall and see and pay attention to what you're buying and, buy what you know. That was kind of from his book. He was a very famous money manager and a very successful money manager. And that's kind of along the way, although I don't recommend making any investments just on that observation. What I'm trying to say is anecdotal evidence can give you hints and clues about what's going on in the economy, and therefore before the stock market knows. Here's what I mean. Let's say you're going out to look at homes with your realtor, and you notice that all of a sudden there's a lot more listings available than there have been in the last 6 months or last year that you've been looking. So you might see that there's more supply in the real estate market. And you might also see that maybe those homes aren't selling very fast. That could tell you that the real estate market is ready to slow down. If you also notice that lending is getting very tight and nobody is able to get loans, well, that can tell you that, again, if the banks aren't lending, that could ultimately mean a slowdown in real estate if people aren't able to finance their homes. Here's another way. Let's say you flew on an airplane and you noticed that the airplane was full, the airport was very busy, and you noticed that a lot of people were flying. Flights seemed to be full, and the airport seemed to be full, and therefore, airline travel had really picked up. You would have some good anecdotal evidence that might not be priced into the stock market yet, and that might help you buy some airlines or maybe even look at hotels and have a good sense that they were, while not back to normal, maybe well on their way to improving. It's what they call the second derivative. It's the change, it's the improvement. If you can see that there's improvement happening, then you might know something before the market knows it. So that's kind of a fun thing. Another thing you might notice is supply chain disruption. One of my friends was remodeling her home and she was trying to get cabinets. She found out her cabinets were they were out of stock, and that they were made in China. When she asked how long it was going to take, the company she was ordering them from said they really didn't have a good idea how long it was going to take, that the supply chain had really slowed, and maybe it would be 11 to 12 weeks before she'd be able to get her cabinets. Now, you would know that maybe that particular cabinet store was going to have their sales decline because if people can't buy from them, they'll go somewhere else to try to find cabinets right away, if they can. Or you might know that people might go to Home Depot instead and buy what's in stock. And maybe a bigger store like that might have something in stock versus someone who has to order it. So you see, looking and noticing the things that you do daily and the things that are happening around you, whether you go out to a restaurant and notice how busy the restaurant is, or whether you go to a mall and see how busy or not the mall is, these are all things you want to note, and these are pieces of anecdotal evidence that can help you as an investor. And again, another example might be you go to a medical clinic and you notice that the building is very full. The parking lot's full, the building seems full, everybody seems very busy in their offices there in this particular building. Maybe a REIT, a real estate investment trust that invests in medical office buildings might be better than something that invests in retail malls, for example. So gathering your own anecdotal evidence is a great way to do research as an investor. Of course, it's not the only research you want to do. You want to do more research. Find out what their earnings and profits are. Find out what their growth rate is. Find out what their debt is, if any. Find out if they pay a dividend. All different kinds of things that you want to continue to research. But these are the things that can really help you catch trends before anyone else. And especially related to the business that you're in, since you're an expert in that area, you might know what suppliers your business uses, or what websites, or what online services, etc., that other people might not be familiar with. So pay attention to things around you. Notice the anecdotal evidence that you have at your fingertips. Stay away from being speculative or trying to make a quick buck, because that's not going to be a sustainable strategy. Oh, and by the way, if you're trading with that app, I recommend that you find something that is more reliable. Apparently, there's a lot of outages reported with that, and imagine if you went to go sell and you weren't able to complete your trade because of a power outage or an internet outage. Yikes, that could be really scary and also very detrimental to your wealth. So I recommend working with a brokerage who is reliable and whose site does not go down. If you haven't subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be updated as soon as new podcasts are available so you never miss one of them. And if you're looking for a good financial book, check out You're Already a Wealth Heiress, Now Think and Act Like One, 6 Practical Steps to Make It a Reality Now. You get your Wealth Heiress checklist, your Millionaire Action Plan, and it was rated one of the all-time best wealth books by Book Authority, and men love it too. And if you're interested in getting in my inner investing circle, check out the VIP experience. I think it's more important than ever that you have a strategy to maneuver through these volatile times so that you can continue to compound your money. I've got a link in the show notes. Just click on that, answer a few questions, and we'll set up a time to talk. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.